There's a saying in trading and investing that the market can stay irrational longer than you can stay solvent, and the recent price action in the markets shows just that. The entire market is moving lower, yet technology stocks power ahead, moving higher on the back of semiconductors, and now Adobe posting stellar earnings, further adding fuel to the fire. So with market breadth extremely thin and the average stock moving lower, when will the cookie crumble? Today, we're going to discuss that as well as inflation. We got the latest PPI numbers, and while the numbers did come in cool, we need to start asking the question, when does disinflation become outright deflation? And if that is the case, that's something else that the Fed will have to deal with in the months and week ahead. We'll also be talking about the consumer, credit markets, and of course earnings like we always do. So with the S&P 500 closing again at new all-time highs for the fourth day in a row, where do we go next? Is the path of least resistance down, or can we go higher? We've got a lot to talk about, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and a couple of very glaring things we're seeing right now. The very first thing that comes to me is actually just the defensive sectors. Look at real estate, really green, right? Utilities, basic materials, and then stuff like consumer defensives as well as healthcare. These were fairly green in what was a pretty red day overall. Pretty terrible breath if you ask me. More issues in the S&P 500 did decline. I think it was something like 160 advanced. The rest actually declined. So it was a pretty brutal day of breath across the board. But again, Nvidia, semiconductors really held up tech along with Apple and Microsoft. You have to understand a flat day here for Microsoft, and then also Adobe making some big moves after hours. We're going to talk about their earnings a little later, but apart from the same culprits, some of these big boys, and then the defensive sectors, it was pretty red across the board. Software was very red. Same too here with financials, industrials, energy, a large part of healthcare. This section right here of healthcare is sort of like the growth area. Biotech, medical instruments. This is like the defensive area. So the growth sections of healthcare not doing that great. Industrials were really red. It was actually a pretty brutal day in the market when you look at it. And so you dive into the sector analysis. So the S&P 500 right here. So all sectors. This is the weighted average up 0.23%. But let's actually just remove infotech. What we actually saw was real estate was the best performing sector. It's such a small sector. It's not even on here. It's just literally like one of these two sectors right here. Then we had utilities, another small sector that's not on this chart. One of these two sectors. So they were the winners. And then every other sector was in the red apart from staples, which again, a very small sector. In fact, the third smallest sector in the S&P 500, maybe outside of energy, right? Which means the biggest sectors, excluding infotech, were just down in the dumps today. And we had stuff like home services down 0.98%, energy down 0.89%, industrials down 0.64%, consumer discretionary down 0.2%. Same with financials and healthcare and materials. So the overall market sentiment was literally just held up by technology. That was really it. And you could see the size of the technology sector here in the broad context of the S&P 500, up 1.36%. And again, stuff like Microsoft was flat. Apple was only up 0.55%. It was really just semiconductors, and even software was a bit of a dumpster fire in the technology sector here today. So a small handful of stocks, not just holding up the individual information technology sector, right? But also the market as a whole, because the broad market was actually down on the day. Now, the reason why we had a very mixed day of trade here today actually had to do with data. We got PPI. We kind of expected that it was actually going to come in cool. Headline PPI month over month, year over year came in cool at negative 0.2% and 2.2% against the forecast 0.1% and 2.5%. At the same time, core also came in cool. The forecast was 0.3%. The market reported 0%. And then here on the year over year figures, the forecast was 2.4%. We actually reported 2.3% in core inflation. So that actually did help stocks very early. The S&P 500, the Nasdaq, and most indices actually did gap up on this news right here. But then we also got stuff like initial jobless claims. Actually kind of a pretty big miss. 242K was reported against 225 forecast. So this did weigh on the market overall, but the market actually took its footing from the PPI data, because US government bonds, the 10-year yield was down 1.62% and long-term treasuries were actually up 1.47%. As a result, the S&P 500 was up 0.23%, closing at a new all-time high at 54.33. The Nasdaq 100 was up 0.57%, but market breadth was pretty terrible. The IWM was down, and actually down in after hours as well. Very interesting. interesting. RSP fell 0.28%, mid-caps fell 0.5%, and S&P 600 fell 1.02%. Commodities are also looking a bit sick. Gold is looking like it's putting in a lower high. Silver is breaking the key $29 area of support. Crude was down 1.07%, but it's rallied quite significantly off its lows in the last 7 trading sessions, and the dollar firmed up. So the S&P 500, that's another closing high, new all-time high. It's actually the 4th day in a row that we've had a new all-time closing high here for the S&P 500. But at the same time, we can actually have a look at stuff like the advanced decline line actually moving down as the S&P 500 is moving up, a huge and wide divergence here. But that doesn't mean it can't keep going up higher. It definitely can, especially if we get the call gamma resistance move up to 5,500. We then actually may just see the 5,500 strike trade before we see any downside. Guys, just remember that the market can stay irrational longer than you can stay solvent. And we also see some very glaring things here in the RSI, very overbought in the S&P 500. And I believe it's the same here with the Nasdaq 100, very similar situation, far more overbought, more issues also declining. And same is true here with the RSP, although not quite as overbought, relatively stagnant, trading at the 50 level. And I mean, this price action, again, we're trying to get a note from the RSP. You can actually see that at this point right here, if it breaks above, that would be trend continuation. But right now it's made lower highs and higher lows. So it's sort of just like coiling, and we're probably going to keep coiling until we get a move to the upside or the downside for the RSP and the broader market. But let's actually dive into the S&P 500 a little bit more in depth. Let's just close down these charts and let's look at the 5-minute chart really quick. So you can see we got the PPI news right here, gapped up on the open, traded down. Then buyers came in, found value here at the 5,400 area, and then we actually rallied all the way up, pretty much closing slightly above the open of the day, but not quite at the day's highs that we made very early here in the session. So both the bulls and bears had their day, but because of the gap up and because of the momentum we saw and because of the data, the bulls actually did eke out a gain in the S&P 500 and slightly in the Nasdaq 100. I think what really helped the Nasdaq 100 was semiconductors. ABGO was up like 12% on its earnings yesterday, and I think we're going to see even more upside in technology simply because of Adobe's earnings. We can actually see that the S&P 500 is up 0.5%, 0.9% here in extended hours trade. This is just the futures, so a little bit upbeat. Same with the Russell, a little bit upbeat here in extended hours for the most part. Now, where do I actually see the market going? So the exact same rules apply. Now, 5,400 is the call resistance right now, so ideally, you know, this 5,400 is going to be used as a strong support if we do get that. But if we do break below, but ideally we want to be below the 5,400 area and just trade in and around this range. But it does look like we're probably going to move up to the 5,500 strike, and if that is the case, we're going to buy dip, sell rips to the 5,500 and look to areas like the 5,400, the 5,450 as potential buy zones as we rally to this area. So I think we have to wait for gamma over the weekend to see what that's going to look like. If we do get a move up to the 5,500, don't count out a move to 5,500 before OPEX next week. That being said, we're still in positive gamma, so you want to be buyers of dips, sellers of rips, but there is some very concerning stuff with market breadth, stuff like the advanced decline line. You know, this is never a good thing. You can actually see that if we pull up the rally for most of the year, this is the year-to-date chart, you can see that as the S&P 500 made new all-time highs, the advanced decline line continued to do so. We also made new all-time highs at this rally right here, but this rally right here is not being supported by the advanced decline line, and that just means pretty much more issues are declining than issues are advancing, and that's why this is moving lower. So you know, things are looking a bit sick in terms of technicals, but again, the options market is driving stocks. A small amount of constituents that have huge index weights are moving the market right now: Apple, AVGO, Nvidia, Microsoft, Meta, Google, and we could probably see continued upside until June OPEX. Once we have a lot of this gamma roll off the tape, then you know, we could probably start moving to the downside a bit more. But for now, we're in positive gamma, and that means buy dips, sell rips with a lean to the upside. And especially if the gamma flip zone moves to the 5,500 area, then we could actually see a pretty crazy run of like 70 points to the 5,500 area from next week, depending on where Friday's end of day closes. Now let's actually talk about gamma. And if you follow me on Twitter, you would have seen this already. It does look like sometime next week, early next week, maybe even by tomorrow's trade, that this 5,400 core resistance is probably going to move up to this 5,500 area. If that's the case, we're buying dips, selling rips to the 5,500 area. It's not there quite yet, right? And nothing else has changed. The put support and gamma flip zone is still at this 5300 area. But guys, if we get to this 5500 area here in the core resistance, we're buying dips, selling rips, and that's just further upside into June OPEX next week. And that's very much a possibility, by June OPEX if this does move up, let's say tomorrow by the latest Monday. If we get a core resistance move to the 5500 and it actually stays there throughout the week, it's a very real possibility that we see that by next week. Crazy to see maybe another, 30 to 60 points in the S&P 500 in a week from now. But buy dips, sell rips, we are still in positive gamma. There's a lot of positive gamma in the tape, and I don't think the upside is going to stop until the window of weakness. Once we have all of this gamma roll off the tape, then we can probably see the bears move the market a bit. But until then, stay long, buy dips, sell rips. Now looking at the AAI sentiment survey, and what happened with regards to this week's price action is exactly what you would think would happen in sentiment. We saw bullish sentiment increase from 39% to 44%. We saw bearish sentiment decrease, with the neutral pretty much staying as it is, a slight increase ever so slightly. So pretty much those that were bearish right here just took a position in the neutral camp or potentially here in the bullish camp. And historically speaking, relatively speaking, we are still at very elevated levels here. And even when we hit 39% last week and the week before, this is still well above the historical average. And we're back to this like above 45%, 44.6% range, which is pretty bullish. And in a bull market, you need bulls, and that's the sentiment we have right now. Sentiment is bullish, but it's not to say they aren't bears. They are. It's just that the bullish momentum supersedes them. Now guys, let's quickly dive into earnings. Now we look at S&P 500 earnings and Mag 7 earnings pretty much every single week, but we rarely tackle mid caps, small caps, Russell 2000. So I have the data here. This is the latest data as of, I believe, just a couple of days ago. So we can actually see that Q1 earnings, this is blended earnings growth. You can see here that mid caps, they have actually reported negative 1.8% earnings growth. These are year-over-year quarterly figures. S&P 600 been a bit of a dumpster fire, negative 14.49% here, and then Russell 2000 earnings negative 2.99%. Now what we are expecting for the second quarter here in mid caps is 1.22% for 2024, then 6.43% in the third quarter, and then 12.67% growth. And then tallying everything together for the full year 2024, we're expecting 1.45% earnings growth, and that would mean the S&P 400 trades at a 16.2 times forward. Earnings do get significantly better in 2025. You can see full year earnings looking at 16.63%, and if this is to materialize, that would mean the S&P 400 trades at a 13 PE. Very, very reasonable if you look at 2025 earnings. In fact, probably below the historical average. I think S&P 400 probably trades at about this, maybe slightly less than 16 as its historical multiple. So you're definitely getting some great companies in the S&P mid caps. A lot of hyper growth names are in the mid cap index. So if you are looking for growth at a reasonable price, this is one index you should look at. S&P 600, a very similar situation to mid caps. We're looking at negative 14.59% growth, then negative 10, then 8% growth here in the third quarter, then 13.98% growth in the fourth quarter. For full year 2024 earnings of 2.34%, it currently trades at 15.5 times earnings. Now I just want to superimpose small caps right here to the Russell 2000 and just a value discrepancy. Now on a PE basis for the full year 2024, the Russell 2000 currently trades at 26.4 times, and that's part of the reason why small caps are actually going sideways, whereas S&P 600 is a little bit stronger, just because S&P 600 is a bit cheaper on a relative basis. This gap does kind of shorten towards the end of 2025. You can see here that full year 2025 earnings for the S&P 600 is expected to be 19.1%, and it should trade at a 13 forward, whereas the Russell 2000 is looking at 34% growth for the full year 2025 and trades at 19.7 times. So out of these indices, which one would I pick? I would probably go with the SP 600 and then the S&P 400. There's just slightly higher quality constituents here compared to the Russell 2000, and you're actually getting the overall index cheaper. Yes, earnings growth is not quite as stellar, but that's because the Russell 2000 is coming off relatively easy comps the year prior. Now looking at global earnings, I don't actually have the exact stats, but the earnings revision ratio fell in the world last week, but the trend remains strong. You can actually see here that from January 2024, the earnings revision ratio has actually moved up, and that pretty much means analyst estimates are actually being revised to the upside. Now this encompasses the developed markets, so it includes most of Europe, Australia, New Zealand, quite a bit of Asia, and doesn't doesn't include any emerging markets. So we are seeing earnings getting revised to the upside, and we should see that continue to accelerate into the rest of 2025. Very similar to what you saw with midcaps and S&P 600 earnings. That's what the rest of the world is doing. We should have a couple of quarters of a slight decline to flat earnings, and then we should see earnings prove to be very strong in the second half of 2024 and throughout 2025. Let's talk a bit about FOMC CPI yesterday. We got a note here from Goldman Sachs. I'm just going to read it. Very interesting. The June dot plot delivered a hawkish surprise with a median projection of 1 cut in 2024 instead of the 2 that we and the consensus had expected, but Chair Powell emphasized in his press conference that many participants saw it as very close and both options are still plausible. The market implied probability of a cut by September rose from 59% this morning to a peak of 85% after the soft CPI report, and then fell to 65% after the FOMC meeting. We continue to expect a first rate cut in September and a second cut in December. Our 2024 inflation forecast is now a touch below the FOMC's, which Chair Powell characterized as fairly conservative. With 2 better rounds of inflation data now in hand, we think that if the next 3 rounds are in a similar range, the leadership is likely to push through a cut in September. Powell made a few other noteworthy comments at his press conference. First, he said the labor market data would have to be worse than the FOMC is expecting to add to the case for a cut. A slightly higher bar following the uptick in the FOMC's employment path and NIRU estimate today. Second, he again downplayed the relevance of neutral rate estimates, where the median rose today to 2.75% for monetary policy decisions. Third, he said that the next framework review will begin late in the year and will cover the Fed's communication strategy. So this is what BOFA is pretty much expecting. If we get these month-over-month figures, right, for core PCE, core CPI through these months, June, July right here, August, and then September, if everything goes according to plan, the year-over-year core CPI figure should be 3.54%. The core PCE year-over-year figure should be 2.81%. On a 6-month annualized basis, that'll be 3.22% and 2.67%. And if we achieve these numbers right here, Goldman do expect the first cut in September, and then we can assess the situation from there. So the way everything looks right now, with the way the labor market is holding together, with the way inflation is coming down, if everything stays as is, in other words, stronger growth, a robust labor market, inflation coming down, the Fed will definitely be in a position where they can cut rates without worrying about something like a wage price spiral or the economy getting a bit too hot. Everything is looking right now like cuts for September, and I think the market is going to start pricing that in. And at the same time, something that no one was really talking about was actually Fed's QT taper. The Fed QT pace will actually start slowing here in June. So pretty much next month, QT taper is going to go from about $80 billion every single month. We're going to drop that to about the $50 billion mark. So essentially, instead of $80 billion, the Fed's just going to let $50 billion worth of assets roll off their balance sheet. And that's probably going to decrease every single month up until December right here, where we'll probably be looking at about $40 billion worth of assets rolling off the balance sheet. And I do believe that this number will approach 0 by March 2025. And that's when the Fed won't be having any assets rolling off their balance sheet. Now, this is actually a really, really good thing for long-term bonds. I put this on Twitter on May the 4th as part of the reason why I said it's time to get into TLT, because with Fed QT taper, issuance pressure is reduced by 20%. That meant that the high for the 10-year yield is likely in for the year being 2024, and that pretty much means long duration TLT risks, or long-term bonds, the risk to reward is asymmetrically skewed to the upside. And that means long-term bonds with rate cuts coming right now is a great time to get into them, especially if you're going to hold them over the next couple of years. Collect your coupon, collect your capital appreciation. Long-term bonds look like a good play based on the macro right now. Along with a data-heavy week, we also have earnings this week. Today, we're actually going to have a look at Adobe. Yesterday, we got Broadcom with their fantastic earnings. Same here with Oracle. Although Oracle did miss on both the EPS and sales side, their guidance was really, really good. But let's talk about Adobe. Adobe's earnings, a double beat, and they actually raised guidance. Very, very good earnings. You can actually see the stock was up nearly 16% here in the after hours, and that's because Adobe reported earnings of $4.48 against $4.39 on sales of $5.31 billion. Market was expecting $5.29 billion. So not a huge double beat, but a double beat nonetheless. And they also raised guidance. And this is what the market was really giddy up about. Look at this, right? So they expect EPS to be in the $4.50 range versus $4.10. That was the market's expectation. This is for Q3. And then sales or revenue was expected to be $5.3 to $5.4 $24 billion. The market was just expecting a flat $5 billion, and that's why we actually see a huge beat, more than 10% here on the EPS side for guidance. And that's why we saw the market absolutely rally on these Q3 guidance numbers right here. At the same time, full year 24 earnings per share, $18 is the market expectation at the low end. The street was expecting $16.78, and then on sales of 21.4 to 21.5 billion, the market was expecting 19.9 billion. So Adobe is definitely generating the right amount of revenue somewhere, because revenue figures are well above the street's expectation. Like, this is a pretty big beat. This is like 5 to 10% above the street's expectation. 19.9 billion to 21.5, that's 1.5 billion more. That's about a 7 to 8% increase on the full year sales. So I haven't fully looked into how they're getting this number. Maybe they've attached more clients, maybe it's price increases, I don't really know, but the street likes it, up 16%. This is like a $300 billion company, I believe. Great earnings here from Adobe. Congratulations to all shareholders. So we're going to have a look at a couple of consumer sentiment measures. This is just questions that BofA asks the average consumer, and it's with regards to big ticket spending, because at the end of the day, we all at some point have to buy a new house, a new vehicle, or a big ticket item, whether it be an iPhone, an iPad, a laptop. We all have those expenses, and the consumer's ability to make a big ticket purchase just goes to show the strength of that consumer, and by extension the economy. So BofA asked, do you plan to buy a car or other personal family vehicle or truck in the next 12 months? Respondents here from June 2023 actually ticked up to just above the 40% mark, and you can actually see we've been slowly moving upward here, and that just goes to show that consumers definitely want a new car and probably have the means to do so. At the same time, similar question, new home. Do you plan to buy a new home, apartment, or condo in the next 12 months? 24% of respondents in June 2024 expect to spend money on a new home in the next 12 months, and this probably will coincide with rate cuts. And we can see that this is some of the highest levels we've actually attained, apart from what we saw here the start of 2023. Apart from that, respondents are definitely planning or looking to buy a new home that coincides with rate cuts. And what this also tells us is that consumers and respondents are probably sitting on quite a bit of cash, liquid cash, cash in money markets, cash in personal savings, and they're looking to deploy that cash in the form of a house, and that's really, really healthy. At the same time, new baby expectations over the next 12 months is the highest since February 2023. Very interesting. Are you or your partner trying to have or adopt a little baby child? And you can see here that normally when people want children or expect to have children, it's normally when the economy is doing a bit better than expected. Normally when this is going down, kids don't want to have a child. They don't want a liability that's going to cost them food, electricity, water, and their time. But when the economy is going good, when they're making a bunch of cash, when they have a ton of free time, they can't afford to do so, people definitely do want kids, and that's what we're seeing right now. So all of these measures, all of these consumer sentiment measures are just telling us that the consumer is actually hanging in there. They probably have cash ready to go, and they can probably weather through a storm, and that's a really, really good thing for the economy, especially for the next 12 months. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.